If you have $400,000 saved and you are over 68 years old, the next decisions you make could determine whether you spend your final decades in comfort or in anxiety. I am going to show you exactly how I would allocate that money, dollar by dollar, to generate income, preserve capital, and let you sleep soundly every single night. $400,000 is a meaningful sum. It is not wealthy by any stretch, but it is enough to make a real difference in your quality of life if allocated wisely. The problem is that most people at this stage receive conflicting advice. Their broker says one thing, their neighbor says another. The financial media says something different every day. The confusion leads to paralysis or worse, to decisions driven by fear rather than cleverness. I have spent over 7 decades thinking about capital allocation. It is what I do every day. I decide where money should go to generate the best risk-adjusted returns over time. And while I typically think about allocation in terms of billions, the principles are exactly the same whether you have 400,000 or 400 million. Let me take you back to 1956 to explain how I developed my approach to allocation that year. I started my first investment partnership with $105,000, most of it from family and friends. I was 25 years old, and I had to decide how to allocate that capital across different opportunities. The easy path would have been to spread the money across dozens of stocks, to diversify so broadly that no single decision could hurt the partnership. That is what most money managers did then, and it is what most do now. But I chose a different path. I concentrated the partnership's capital in a small number of opportunities where I had high conviction. When I found something I understood deeply and believed was significantly undervalued, I allocated heavily. Sometimes a single position would represent 25 or 30% of the partnership. This approach required courage. It meant that mistakes would be costly, but it also meant that successes would be meaningful. Over the 13 years I ran that partnership, we compounded at nearly 30% annually, far exceeding what a diversified approach would have produced. The lesson I learned was that thoughtful concentration beats mindless diversification. Not reckless concentration in speculative ideas, but thoughtful concentration in opportunities. You truly understand. This principle has guided every allocation decision I have made since. For someone over 68 with $400,000. The same principle applies. You do not need 30 different holdings. You do not need exposure to every asset class. You need a focused allocation to high-quality assets that will generate income and preserve purchasing power over the decades ahead. Before I share my specific allocation, let me explain the framework I use for making these decisions. This framework has 3 components that must be balanced against each other. The first component is income generation. At 68, you are likely drawing from your savings rather than adding to them. You need your portfolio to generate cash you can spend without depleting principal. This income must be reliable, consistent, and ideally growing over time to offset inflation. The second component is capital preservation. You cannot afford a 50% decline that takes years to recover. You need to protect what you have accumulated over a lifetime of work. This does not mean avoiding all risk, but it means avoiding catastrophic risk that could permanently impair your standard of living. The third component is growth. Even at 68, you might have 20 or 30 years ahead of you. Inflation will erode your purchasing power by 40 to 60% over that time if your assets do not grow. You need some exposure to assets that appreciate faster than inflation. These 3 components often conflict. The highest income investments are often the riskiest. The safest investments often provide no growth. The highest growth investments often pay no income. The art of allocation is balancing these components in a way that serves your specific needs. For someone over 68 with $400,000, I would allocate the money across 4 buckets. Each bucket serves a specific purpose, and together they provide the income, safety, and growth you need. Let me start with the first bucket, which I consider my second most important recommendation because my most important one comes next. The first bucket is your safety reserve. I would allocate $80,000 or 20% of your total to this bucket. This money goes into the safest possible investments: treasury bills, money market funds, or high-yield savings accounts at federally insured banks. The purpose of this bucket is psychological as much as financial. This is the money you do not worry about. It does not fluctuate with markets. It does not decline when stocks crash. It sits there completely safe, earning a modest return, ready to fund your expenses if everything else goes wrong. At current rates, this $80,000 might earn 4 to 5%, generating $3,000 to $4,000 per year in income. That is not enough to live on, but it is a meaningful contribution to your expenses. And more importantly, it provides peace of mind. This safety reserve also gives you staying power. If the stock market drops 40%, you do not have to sell stocks at depressed prices to fund your living expenses. You can draw from your safety reserve while waiting for stocks to recover. This ability to wait out downturns is worth far more than the modest returns you sacrifice by keeping money in safe assets. The size of this bucket, $80,000, is enough to cover approximately 2 years of supplemental income for most retirees, combined with Social Security. This buffer ensures you can survive any market downturn without being forced to sell at the worst possible time. The second bucket is your income engine, and this is my most important recommendation. I would allocate $160,000 or 40% of your total to dividend-paying stocks. This is where Wall Street usually gets it wrong. They tell retirees to buy bonds for income, but bonds pay fixed coupons that do not grow, and those coupons get eroded by inflation every single year. A bond paying 4% today will still pay 4% in 20 years, but that 4% will buy only half as much. Dividend stocks are different. Quality companies raise their dividends every year. A stock yielding 3% today might yield 3.2% next year, 3.4% the year after, and so on. After 20 years of dividend growth, your income from stocks will be dramatically higher than what any bond could provide. I would put this $160,000 into a combination of individual dividend stocks and dividend-focused exchange-traded funds. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, and PepsiCo have raised their dividends for 50 or 60 consecutive years. They will almost certainly continue raising dividends for the rest of your lifetime. 8A 3% yield, $160,000 generates $4,800 per year in dividend income. But here is where the magic happens. If those dividends grow at 6% annually, which is below the historical average for quality dividend stocks, your income doubles in 12 years. By age 80, you would be receiving nearly $10,000 per year from this bucket alone. And that is just the income. The stocks themselves also appreciate over time after 20 years of 6% dividend growth. The companies paying those dividends are worth dramatically more. Your $160,000 investment could be worth $400,000 or more, while generating income that has doubled or tripled. Compare this to bonds. If you had put $160,000 in bonds yielding 4%, you would receive $6,400 per year forever with no growth after 20 years. You would still have $160,000, and your $6,400 of income would have lost half its purchasing power to inflation. The choice between dividend stocks and bonds is not even close when you understand the mathematics. Dividend stocks provide growing income and capital appreciation. Bonds provide fixed income and capital stagnation. For a retiree who might live 20 or 30 more years, dividend stocks are overwhelmingly superior. Within this bucket, I would allocate roughly half to individual stocks and half to dividend-focused ETFs. The ETFs provide diversification and professional selection. The individual stocks allow you to focus on the highest quality companies with the longest dividend growth streaks. For the individual stock portion, I would own 6 to 8 companies across different sectors. Healthcare, consumer staples, utilities, and financials all offer excellent dividend growth opportunities. By spreading across sectors, you reduce the risk that any single industry downturn devastates your income. The third bucket is your growth engine. I would allocate $120,000 or 30% of your total to broad market index funds. This bucket is not about income. It is about long-term appreciation. These index funds own hundreds of companies, including the technology giants and growth companies that pay little or no dividends but appreciate rapidly over time. At 68, you might think you do not need growth. But consider this. If you live to 90, which is increasingly common, you have 22 years ahead of you. Over 22 years, inflation at 3% would reduce your purchasing power by nearly 50%. Assets that do not grow are actually shrinking in real terms. The S&P 500 has returned approximately 10% annually over the long term. $120,000 growing at 10% becomes approximately $800,000 after 20 years. Even if you spend some of that growth along the way, the appreciation provides a crucial buffer against inflation and longevity risk. I would put this money in a simple, low-cost S&P 500 index fund. No active management, no stock picking, just ownership of the 500 largest American companies, weighted by market capitalization, with fees of 3 or 4 basis points. This index fund approach has beaten most professional money managers over every long time period. It requires no expertise, no monitoring, no decision making. You buy and hold forever, letting the American economy work for you. Some people worry that $120,000 in stocks is too risky for a retiree. But remember, you have $80,000 in safe assets providing a buffer. You have $160,000 in dividend stocks providing income. This $120,000 is your long-term money. Money you will not need for 10 or 15 or 20 years. Over that time horizon, stocks are actually less risky than bonds because they outpace inflation while bonds do not. The fourth bucket is your tactical reserve. I would allocate $40,000 for 10% of your total to this bucket. This money is for opportunities and emergencies. It sits in a money market fund or short-term treasury bills, earning a modest return until you need it. The opportunities might include a chance to buy more dividend stocks during a market panic, when stocks fall 30% and everyone is terrified. This is the money you deploy. Buying quality companies during panics has been one of the most reliable ways to build wealth throughout market history. The emergencies might include unexpected medical expenses, home repairs, or family needs. Having $40,000 available means you do not have to sell stocks at bad times or raid your long-term investments to handle life surprises. This bucket also provides psychological comfort. Knowing you have $40,000 in reserve on top of your $80,000 safety bucket means you have $120,000 of liquid assets available for any need. That is enough to handle almost any emergency without disrupting your investment strategy. Now let me synthesize how these 4 buckets work together. Your total income from this allocation would be approximately $8,000 to $10,000 per year in dividends and interest. Combined with Social Security, this likely covers most or all of your basic expenses. Your safety comes from $120,000 in cash and near-cash investments. This buffer protects you from being forced to sell stocks during downturns. Your growth comes from $120,000 in index funds, plus the appreciation of your dividend stocks over time. This growth maintains and increases your purchasing power despite inflation. The allocation is simple enough to understand completely, but sophisticated enough to serve all your needs. You know exactly what you own and why you own it. Let me now discuss how to implement this allocation. If you are starting from a different position, if you currently own a complicated portfolio of dozens of holdings, do not try to restructure everything at once. The tax implications could be significant. Instead, plan a gradual transition over 12 to 24 months. Start by identifying any positions with losses. Sell these immediately to harvest the tax losses, which can offset gains elsewhere. Use the proceeds to fund your safety reserve and tactical reserve. Next, identify positions that pay dividends consistent with your income goals. You may already own some of the dividend stocks I mentioned. Keep these and add to them as needed. Then, identify positions that should be consolidated in the index fund bucket. Individual stocks that you no longer want to monitor can be sold gradually and replaced with index fund shares. Finally, identify highly appreciated positions that would trigger large capital gains if sold. These may need to be held longer or donated to charity if that aligns with your estate planning. Throughout this transition, keep your target allocation in mind. Every decision should move you closer to the 80-160-120-40 split I described. Within 2 years, you should be fully allocated according to this plan. Let me address the question of rebalancing, because your allocation will drift over time as different assets perform differently. I recommend reviewing your allocation annually on your birthday or some other memorable date. If any bucket has drifted more than 5 percentage points from its target, rebalance by selling from the overweight bucket and buying into the underweight bucket. For example, if your growth bucket has increased from 30% to 37% due to strong stock market returns, sell enough index fund shares to bring it back to 30%. Use the proceeds to replenish your safety reserve or tactical reserve. This annual rebalancing accomplishes 2 important things. First, it maintains your risk profile by preventing any bucket from becoming too large. Second, it forces you to sell high and buy low, taking profits from winners and adding to laggards. You can also rebalance through spending decisions. If you need to withdraw money for living expenses, withdraw from the most overweight bucket. This natural rebalancing reduces the need for explicit sales and their associated tax consequences. Let me also discuss what to do during market downturns, because this is when most retirees make catastrophic mistakes. When the stock market drops 20 or 30 or 40%, your instinct will be to sell. Every headline will tell you the end is near. Every expert will explain why this time is different. The pain of watching your portfolio decline will be intense. But selling during downturns is exactly wrong. It locks in losses at the worst possible time. It converts temporary declines into permanent impairment. It violates the most fundamental principle of successful investing. Instead, during downturns, you should draw your living expenses from your safety reserve and tactical reserve. Leave your dividend stocks and index funds untouched. Continue collecting dividends, which you can either reinvest at lower prices or use for expenses. If the downturn is severe and your tactical reserve allows, consider buying more. The best opportunities to build wealth come when everyone else is panicking. A 40% market decline is not a crisis. It is a sale. Your safety reserve and tactical reserve exist precisely for these moments. They give you the ability to do nothing or even to buy more when everyone else is forced to sell. This staying power is the most valuable asset a retiree can have. Let me share some thoughts on how this allocation changes as you age. Age 68, the allocation I described is appropriate. You have substantial time horizon, so you can afford significant stock exposure. Your income needs can be met by dividends and Social Security. As you move into your late 70s and 80s, you might gradually shift toward more safety and income and less growth, perhaps increasing the safety reserve from 20% to 25%, perhaps increasing dividend stocks from 40% to 45%, perhaps reducing index funds from 30% to 20%. But do not reduce stock exposure too quickly. Even at 80, you might have 10 or 15 years ahead of you. That is still a long time horizon. Keeping meaningful stock exposure ensures your purchasing power is maintained through whatever years remain. At some point, your allocation may also reflect estate planning considerations. If you plan to leave money to children or grandchildren, that money effectively has their time horizon, not yours. Assets intended for the next generation can remain in growth investments indefinitely. I want to address the role of Social Security in this allocation because it affects how much risk you can take. Social Security is essentially a a government-guaranteed income stream similar to a very high-quality bond for most retirees. Social Security represents a significant portion of their retirement income, often 50% or more of what they need. Because you already have this bond-like income from Social Security, your investment portfolio can be more aggressive. You do not need bonds in your portfolio because Social Security already provides that stability. You can afford to hold more stocks because your baseline income is guaranteed. This is why my recommended allocation has no traditional bonds, 0% in bonds. This surprises many people who have been told that retirees need bonds for safety. But when you account for Social Security, you already have more fixed income than you need. Adding bonds to your portfolio would actually make you too conservative. The safety reserve I described serves a different purpose than bonds. It provides liquidity and psychological comfort, not long-term return. Treasury bills and money market funds are not the same as bond funds. They do not decline in value when interest rates rise. They simply provide safe storage for money you will need soon. For retirees with pensions in addition to Social Security, the case for avoiding bonds is even stronger. If you have $30,000 or $40,000 per year guaranteed from Social Security and pensions, you have enormous baseline security. Your investment portfolio can be quite aggressive because your basic needs are already covered. Let me discuss specific dividend stocks in more detail because this bucket is so important. The companies I mentioned earlier, Johnson & Johnson, Procter & Gamble, Coca-Cola, PepsiCo, these are what I call dividend aristocrats. They have raised their dividends for at least 25 consecutive years, demonstrating a commitment to shareholders that few companies can match. Johnson & Johnson has raised its dividend for 62 consecutive years. Think about what that means through 13 recessions, through the Vietnam War, through the oil crisis of the 1970s. Through the financial crisis of 2008, through the pandemic, through every challenge the world has thrown at it, Johnson & Johnson continued raising its dividend. This track record is not a guarantee of future performance, but it is the strongest evidence available that management prioritizes returning cash to shareholders. Companies do not build 60-year dividend growth streaks by accident. They build them by generating consistent cash flow and making shareholder returns a strategic priority. When selecting dividend stocks for your portfolio, I would look for several characteristics. First, a dividend growth streak of at least 25 years. This demonstrates durability through multiple economic cycles. Second, a payout ratio below 60%. This means the company retains enough earnings to fund growth and protect the dividend during temporary earnings declines. Third, a strong balance sheet with manageable debt. Companies with excessive debt are vulnerable to interest rate increases and economic downturns. Fourth, products or services that people need regardless of economic conditions. Consumer staples, health care, and utilities tend to have stable demand. Luxury goods and discretionary spending tend to be more volatile. Fifth, competitive advantages that protect market position, strong brands, patents, regulatory licenses, network effects, and other moats prevent competitors from stealing customers. Applying these criteria leads you to a relatively small universe of high-quality dividend stocks. You might own 10 or 12 individual names, each representing 5 to 10% of your dividend bucket. Combined with dividend ETFs, this provides diversification while maintaining focus on quality. Let me address the question of fees because they matter more than most people realize. Over a 20-year retirement, fees compound just like returns. An investment charging 1% annually costs you approximately 18% of your ending wealth, compared to an investment charging nothing. That is a huge drag on your returns. Index funds charge essentially nothing, often 3 or 4 basis points. That is 0.03 or 0.04%. On $120,000, you pay approximately $40 per year in fees. Dividend ETFs charge slightly more, typically 5 to 15 basis points. That is 0.05 to 0.15%. On $80,000, you might pay $60 to $120 per year. Compare this to actively managed funds that charge 1% or more. On $80,000, you would pay $800 per year over 20 years. That difference compounds to tens of thousands of dollars. I recommend avoiding any investment that charges more than 20 basis points. Low fees are not everything, but high fees are almost always a bad deal. The evidence consistently shows that low-cost index funds outperform high-cost actively managed funds over long periods. Let me close with thoughts on the purpose of this allocation and what it is designed to achieve. The goal is not to maximize returns. If maximum returns were the goal, you would put everything in stocks and accept the volatility. The goal is not to minimize risk. If minimum risk were the goal, you would put everything in treasury bills and accept the inflation erosion. The goal is to provide sustainable income, preserve purchasing power, and maintain peace of mind. The allocation I have described accomplishes all three. Sustainable income comes from 40% in dividend stocks, generating growing cash flow every year. Purchasing power preservation comes from 30% in growth stocks that appreciate faster than inflation. Peace of mind comes from 30% in safe and liquid assets that buffer you against any emergency or downturn. This is not an exciting allocation. It will not make you rich quickly. It will not generate cocktail party conversation, but it will work. It will fund your retirement. It will let you sleep at night. After 7 decades of thinking about capital allocation, I have concluded that simplicity and quality matter more than complexity and cleverness. A simple allocation to high-quality assets, maintained with discipline through good markets and bad, will outperform complicated strategies that require constant monitoring and adjustment. $400,000 allocated wisely can fund a comfortable retirement. The allocation I have shared is how I would do it, not because it is perfect, but because it is sound, sustainable, and suited to the needs of someone over 68. Take what I have shared, adapt it to your specific circumstances, implement it with discipline, and then stop worrying about your investments and go live your life. That is what money is for, and not to accumulate indefinitely, not to obsess over daily, but to fund a life well lived. $400,000 properly allocated across safety, income, growth, and opportunity can provide exactly that. The framework I have given you will serve you well for the rest of your life. If you follow it with patience and discipline, now is the time to act. Now is the time to build the portfolio that will carry you through whatever years remain. Do not wait for the perfect moment. Do not overthink the details. Implement this allocation and let time work in your favor. That is the path to financial security at 68 and beyond. Let me share a few more insights that I think will help you implement this strategy successfully. First, I want to discuss the psychology of watching your portfolio fluctuate. This is where many retirees fail, not because they chose the wrong investments, but because they could not handle the emotional journey. When I say your dividend stocks might decline 30% during a market crash, I mean at 30% of $160,000 is $48,000. You will watch $48,000 disappear from your account, at least on paper. That is a painful experience no matter how wealthy you are. The key to surviving this experience is understanding what you actually own. You own pieces of businesses. Johnson & Johnson will still sell bandages and pharmaceuticals during a market crash. Coca-Cola will still sell beverages. Procter & Gamble will still sell detergent and toothpaste. The businesses continue operating regardless of what the stock market does. During the financial crisis of 2008, Coca-Cola stock dropped about 30%, but Coca-Cola's dividend increased that year, just as it had every year for decades. If you focused on the dividend rather than the stock price, you would have seen your income rise while your principal temporarily declined. This perspective focusing on the income rather than the principal is essential for retirees using dividend stocks. Your income is what pays your bills. Your income is what matters for your standard of living. As long as the income keeps flowing and growing, the principal fluctuations are just noise. I recommend tracking your dividend income separately from your portfolio value. Create a simple spreadsheet showing how much dividend income you receive each quarter and each year. Watch that number grow over time. When the market crashes and your portfolio value drops, look at your dividend income instead. It will probably still be rising, which provides enormous psychological comfort. Second, let me discuss the mechanics of actually spending from this portfolio. You have $400,000 allocated across 4 buckets. How do you actually extract money for living expenses? The simplest approach is to live off your dividend income plus Social Security. If Social Security provides $24,000 per year and dividends provide $8,000 per year, you have $32,000 of income without touching principal. For many retirees, this is enough to cover basic expenses. If you need more than your income provides, draw the excess from your safety reserve first. This $80,000 bucket is specifically designed for this purpose. Withdrawing $5,000 or $10,000 per year from this bucket is sustainable for many years. Once per year, evaluate whether to replenish the safety reserve. If your growth bucket has performed well and now represents more than 30% of your portfolio, sell some index fund shares and move the proceeds to your safety reserve. This keeps your allocations in balance while providing spending money. If the market has been down, do not replenish the safety reserve. Let it decline temporarily while your stocks recover. This is why you maintain such a large safety reserve, to avoid selling stocks during downturns. The tactical reserve of $40,000 should rarely be touched for routine spending. This money is for genuine emergencies and opportunities. A new roof, an unexpected medical procedure, a chance to help a family member. Keep this bucket available for true needs, rather than regular expenses. Third, let me address taxes because they significantly affect how you implement this strategy. If your $400,000 is in a traditional IRA or 401k, all withdrawals are taxed as ordinary income. There is no difference between dividends, capital gains, and principal returns. Everything comes out as taxable income. In this case, the allocation I described still applies, but you have additional considerations. Required minimum distributions will force you to withdraw a minimum amount each year starting at age 73. These withdrawals must come from the account regardless of market conditions. I recommend building your safety reserve inside the retirement account rather than outside it. When you need to take required minimum distributions, take them from the safety reserve bucket first. This converts taxable distributions into spending money while leaving your stocks to compound. If your $400,000 is in a taxable brokerage account, the tax situation is different and generally more favorable. Qualified dividends are taxed at preferential rates, typically 15% for most retirees. Long-term capital gains are also taxed at these lower rates. Only short-term gains and interest income face ordinary income tax rates. In a taxable account, the dividend strategy is particularly powerful because qualified dividends face such low tax rates. $8,000 of dividend income might only cost $1,200 in federal taxes for most retirees. Compare this to $8,000 of bond interest, which might cost $1,800 or more in taxes. The after-tax return on dividend stocks is significantly higher than the after-tax return on bonds for most retirees. This tax advantage adds to the already compelling case for dividend stocks over bonds. If you have both retirement accounts and taxable accounts, consider which investments go where. Generally, you want tax-efficient investments like index funds in taxable accounts and less tax-efficient investments like bonds in retirement accounts. Since my recommended allocation has no bonds, you can focus on putting growth-oriented index funds in taxable accounts where their lower turnover generates fewer taxable events. Fourth, let me discuss the role of healthcare costs in retirement planning because this affects how much cushion you need. Healthcare is the largest and most unpredictable expense most retirees face. Medicare covers many costs, but not all. Supplemental insurance premiums add up. Prescription drugs can be expensive. Long-term care, if needed, can devastate a portfolio. The safety reserve and tactical reserve I recommended, $120,000 combined, provide meaningful protection against healthcare costs. An unexpected surgery or treatment might cost $10,000 or $20,000 even with Medicare. A year in an assisted living facility might cost $60,000 or more. If you have particular health concerns or family history suggesting you might need expensive care, consider increasing your liquid reserves. Perhaps $150,000 or $180,000 in the safety and tactical buckets combined with correspondingly less in growth stocks. You might also consider long-term care insurance, though I am ambivalent about these policies. They are expensive, and the insurance companies have significantly raised premiums and reduced benefits over time. For some people, they make sense. For others, self-insurance through a larger portfolio is preferable. The key insight is that healthcare costs are both significant and unpredictable. Any retirement allocation must account for this reality. The liquid reserves in my recommended allocation provide a meaningful buffer, but you should adjust based on your specific health situation and risk tolerance. Fifth, let me share thoughts on working with financial advisors. Many retirees work with financial advisors to manage their investments. Some advisors provide genuine value through financial planning, tax optimization, and behavioral coaching. Others primarily extract fees while adding little value. If you work with an advisor, make sure you understand exactly what you are paying as success, including fund expense ratios, advisory fees, and any transaction costs. Total fees above 1% annually are almost certainly too high. Also, make sure your advisor's recommendations align with the principles I have described. If they recommend complex products, excessive diversification, or heavy bond allocations, ask why. The burden of proof should be on them to explain why their approach is better than the simple allocation I have outlined. Many retirees would be better off managing their own investments using the framework I have provided. It requires only a few hours per year of attention. It avoids advisory fees that compound over time, and it keeps you in control of your own financial destiny. If you lack the confidence or interest to manage your own investments, a fee-only financial planner can help you implement this strategy for a one-time fee. They can review your specific situation, recommend the precise allocation percentages for your needs, and create an implementation plan. This costs far less than ongoing advisory fees and gives you a plan you can follow independently. Finally, let me emphasize the importance of starting. Now, every year you delay implementing a sound investment strategy costs you money. If your current allocation is earning 3% in bonds and my recommended allocation could earn 7%, delaying 1 year costs you 4% of your portfolio, or $16,000 on $400,000. Do not wait for the perfect moment. Do not wait until you have done more research. Do not wait until the market looks safer. The best time to implement a sound strategy was yesterday. The second best time is today. Take the framework I have provided. Adapt it to your circumstances. Begin implementing it this month. Your future self will thank you for the income, the growth, and the peace of mind that come from a well-structured portfolio. $400,000 is enough. The strategy is clear. The path is laid out before you. All that remains is walking it. That is my allocation strategy for anyone over 68 with $400,000. It is simple, effective, and proven over decades of market cycles. Follow it with discipline, and it will serve you well for the rest of your life.